Bismillahirrahmanirrahim. Very good day. In today's lecture, we are going to talk about why investors prefer indirect finance over direct finance. As we have learned that these are the two ways of making financial decisions of investment. Sometimes you go directly and you make investments directly to the companies which actually need money. And sometimes you do this kind of investments through different kind of financial intermediaries. These financial intermediaries may be banks, mutual funds, or other kind of the financial institutions. To begin with, we start with the definition of finance like direct and indirect finance. In indirect finance, what actually happens when you basically are going directly to make investments, you try to transfer this money directly to the companies that actually require money. There is no involvement of a bank or financial intermediary. There is a direct relationship between the borrowers and lenders, investors and saver. In case of the indirect finance, there is involvement of in financial intermediaries. A person who saves money does not go directly to the person who wants to make investments with that money. They give this money to financial intermediary like a bank or mutual fund or any other kind of the financial institutions. They make investments on behalf of those people like who actually are saving money. So this in this way, this is an indirect finance. Now, there are different kinds of aspects that we need to know about the direct and indirect finance. Like, say, for example, the direct finance basically has got a very good advantage of getting the whole return from your investments. You don't have to share your returns with anyone. And that what makes this very attractive. So many people who wants to get hold of all returns try to prefer the direct finance. But you should also remember that when you're taking the whole return, you also have to bear the whole risks. So this risk and return expectations perhaps may actually take you to the direct or indirect finance, but generally, like the returns expectations or returns demand basically can take you to the direct finance. Similarly, you may basically have got a very good control and of the decision making of your investments. In case of the direct finance, you are in the driving seat and you have to make all decisions and you are making all the decisions. But in case of indirect finance, the companies make decisions on your behalf. And similarly, sometimes you feel that your knowledge is superior to others, and that's what makes you more confident in going directly to for the investments rather than going indirectly through the financial intermediaries. In case of the indirect finance, you basically have got an ability to mitigate risk. Like say, for example, your financial intermediaries that you give money to may have got a very good models to mitigate those risks. And they also have got very good professional management. The people who basically are good at these kind of things manage your money. So generally, the money that you give to these all financial intermediaries go into the safe and professional hands. And these professional people actually multiply your money and share their profits with you. Another very good advantage of the indirect finance is the liquidity. Like say, for example, if you buy a bond directly from a company, you basically have to wait for it to mature to get your money back, or you just sell it into the secondary market. That may involve some cost. But if you are investing with through the indirect institutions, like say, for example, indirect finance, just choosing the indirect finance and you are making investments through financial intermediary, you may withdraw your money at any point of time. Now, there are very important questions that why financial intermediaries play such a large role in debt financing. Why not the direct finance? Why don't businesses simply basically sell directly to the companies, and that basically why the direct borrowing investment takes place directly? The answer lies in the transaction cost, according to Mishkin. Like the obtaining debt financing through the financial intermediary or making investments through the financial intermediary can reduce your transaction cost. Now, the transaction cost is basically, is the cost that you actually have to incur to make your transaction valid or just possible. Like, say, for example, if you are trying to lend some money, you have to find people who want to borrow your money. So the time involved in this particular kind of transaction is basically is your opportunity cost. Like, say, for example, you're waiting for 1 month or 2 months or 3 months, like, say, for example, to get the right investor. That may basically cause you lose your interest rate for those kind of months, and you may basically not be able to get a good deal if you are not basically having or able to find out the right people. Secondly, these financial intermediaries have got large kind of operations which actually help them reduce their transaction costs by actually having the advantage of economy scale. So another reason for these financial intermediaries to be very popular amongst the investors and the people basically is the problem of asymmetric information. Financial intermediaries use actually reduce And the problem of asymmetric information arises when one party lacks crucial information about another party, and that may basically have a lot of impact on your decision making. We actually discuss these kind of problems called like along the two fronts, like say for example, adverse selection and moral hazard. These asymmetric information sometimes create the problem of adverse selection and sometimes the moral hazard. What are these? Basically, we have to look further now. The adverse selection is a problem that arises for the buyers of assets when they have difficulty assessing the quality of these assets. Like, say, for example, what kind of bonds are you buying? You may choose your investments right wrongly if you are not able to actually analyze the bonds and you are not able to analyze that who basically are the borrowers and what kind of financial conditions they have. The borrowers, generally the people who sell those financial assets, have got very good private information that actually is more accurate than you people have got, like as a buyer of those buyer of those financial assets. So that may basically cause a kind of asymmetry between the borrowers and lenders. The borrowers basically have got very good information about their financial health. They know what exactly their financial health is. They know basically what kind of plans they have got and how successful they may or may not be. But like the people who give money, they basically don't have got the information. So that may cause a selection of the person, basically, you just basically just make investments with. How do they do that? Like, say, for example, how do they reduce the adverse selection problem? This adverse selection problem can be dealt with if you are actually screening your borrowers very thoroughly. For that, you need workforce. For that, you need skills. For that, you need money. And that money is available and that skills are available to the financial intermediaries. And they basically use that well. And they try to screen the borrowers. They try to check their credit history. They try to check their financial health. They check their business plans and all of the relevant factors. They may or may not be basically very much influential in their success of the investment decisions. Another way of actually assessing those is giving the credit score. That is a quantitative way of just finding out that whether this particular concern is good enough to make investments or not. Another problem that may arise in case of the indirect finance is the moral hazard. Like, say, for example, when you just give some money to somebody, like the person may not use that money prudently. This problem may occur after the completion of financial transaction. It is about the hazard that borrowers may engage in undesirable activities, making it more likely that one pay the loan back. Say, for example, the insurance company may basically give money to those people who are basically are involved in risky activities. Like, say, for example, a person who takes health insurance may involve in some kind of reckless activities that may cause a loss to the firm or the insurance company, which actually is not a natural loss, just because, but it is because of the in recklessness of the person basically who has borrowed, who has taken the policy. So this is the another view of the conflict of interest. Thank you very much for joining us. Just keep tuned and just keep watching us for the next videos. Thank you very much.